Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is economist and real estate expert Richard Barkham. Now, Richard joined CBRE back in 2014 as a Global Chief Economist, and in 2018, he was appointed Senior Economic Advisor. He's based in Dallas and leads a team of 600 researchers nationwide. He holds a PhD in economics and is the author of two books and numerous academic publications. On a part-time basis, he is senior fellow and lecturer in real estate at Harvard University and a professor of the practice at University of North Carolina. He is also a chartered surveyor, counselor of real estate, and honorary professor of the Bartlett School of Sustainable Construction at the University of London. And so, guys, with that, it's an honor to welcome our guest for today's show, Richard Barkham. Richard, my friend, how are you doing today?
I'm very well, thank you. I'm in Boston and enjoying it. Yeah, so I'm very well, and thank you for having me.
Yeah, no, thanks for joining us here today, and so excited to have a conversation with you. I know we were chatting just a little bit here before we started recording, just what's happening out there in the world today as it relates to commercial real estate investments, and from a localized perspective, from a national and international perspective. So maybe let's before we go into the meat and potatoes and dive down those rabbit holes. Richard, maybe I gave you that brief introduction there. Maybe expand upon your background a little bit for those folks that aren't familiar with you, that don't know who you are. Tell us a little more about yourself, if you would.
Yeah, thank you. So it's sort of 40-year career, and I'm transitioning away from that role of chief economist and head of research, where I was managing 700 people. And I'm now senior economic advisor with CBRE, and I'll probably be retiring from the company in June, which is not to say I'm coming to the end of my active life. I'm taking on some advisory positions and possibly going back to being a university professor. So I've had a three-part career. First 14 years, I was a professor of real estate finance at the University of Reading in England, which runs Europe's largest real estate program. And then when I realized I wanted to earn more money than a university professor, I joined a fascinating company called Grosvenor, which is the private property company of the Duke of Westminster
Hmm.
in London. The core assets of that company are Mayfair and Belgravia. And I was, variously head of research, head of strategy, director of fund management for 14 years. And I think you finished off the rest of it. 2014, CBRE asked me to become their chief economist. So I'll just revert back really to the Grosvenor experience, because Grosvenor is a company that's 300 years old. It's an older company than America, and the core assets in Mayfair Belgravia had really served the company well as income producing assets for 200 years.
Wow.
And you just can't get that kind of longevity in any other asset than real estate. So, that's just a fascinating, insights I got from working for that company.
Well, talk to me about the transition from Grosvenor to CBRE. I mean, quite two very, very different types of firms. I'm sure that there was a little bit of a learning curve, I guess, or maybe just getting used to things.
Yes, I mean, I was going from client side private equity, real estate private equity, to client side advisory.
Hmm.
Of course, being with a big private equity company, you learn to work with all of the advisors, and you make better decisions in private equity if you take advice. So I'd got used to working with the big advisory companies, and my job wasn't that different. I was organizing deployment of research resource, how to understand, how to answer the questions the clients were forming in their mind but hadn't asked yet. I'd have to do the research that answered those questions, and I did that at Grosvenor, and I did that at CBRE. So and after a while, you know what it's like. You sort of get an instinct for what people want to know about, and so it wasn't quite so different as you might imagine.
Just curious, from an understanding of what it's like to manage people. You had a team of 700 underneath you. Help me understand what it's like to disseminate information from 700 folks across the world and distill it down to something that's digestible to the masses.
Well, I think over the, whenever you're running a big team, you've got to get the structure in place that gets you down to a manageable level of reports, people reporting to you. So you've got to get a workable organization structure. And then the secret of management, in my view, is getting the right people in the right jobs. Then you've got to get as I say, the right people in the right jobs. And over the course of 14 years, we very much moved away from long form kind of white paper research, which, investment banks still put out, and there is a place for it. But we just try to encourage everybody to use infographics, to use as few words as possible, and just get the key points over as quickly as possible. And we move to writing more effectively. I personally, I try to write research in the same way as a sports journalist might write about a football match. You can get a football match into 3 paragraphs. And you've got to keep people's interest. You've got to engage people, with that first word or 2 words. That's what I'm trying to do with CBRE's research. Just get it short, pithy, and engaging.
Obviously, we've seen quite a big evolution with AI over the last 5 years, more specifically over the last 2 years. Just curious, has there been any adoption of AI, in your current role department, the side of the CBRE that you spent your time, and then in addition to that, I guess it's more from a larger scale, what do you foresee happening here over the next couple of years as it relates to AI truly reshaping the commercial real estate space as we know it today?
I mean, the first thing that I would say, the first deployment of AI, and I run a team, as I say, 730 of them are economists, and they're doing econometric models.
Hmm.
So the first deployment of AI is just, you can, instead of running 10 models yourself and trying to figure out, you can get AI to suggest what are the 10 best models that you
Yeah.
can, utilize to estimate the relationship between these 2 variables. And then, if you're coding that in R or Python, you can get artificial intelligence to do your coding for you. So, there is the deployment of AI, just, to do the actual analytical work. It never quite, obviates the need for a human brain to look at that and make sense of it. And then, we're using AI, I think, to help write reports. Now, as I say, we've moved away from too much verbiage, anyway. So the time saved using AI just to write reports is relatively light, but
Hmm.
that's what we're looking at. And what it is with real estate data. It's you can have all of the components of a deal, and you still don't quite know what happened there. So, we using AI to get data on transactions, or comps as we call them, and clean them up and make them sensible. That's like the holy grail, but we're not there yet.
Yeah, yeah. We really been trying to leverage it inside of our organization. It's more of we think of it as a thought partner, more of a thought partner, someone to lean on a little bit, but ultimately still have to, you have to provide the necessary data points, and guide along the right path. But surely I think there's a lot of efficiencies that we've gained inside our organization as we look to adopt it and have other leaders in the company start adopting it and distilling it down through the rest of the organization. But it's got a long way to go. But it's interesting to see that I could tell you that I had no involvement and hadn't even stepped on the Chat GPT one time a year ago. Now today, I probably spend a couple hours a week leveraging just ChatGPT alone inside the organization. So it's just interesting to see how it's evolved and how it's brought a lot of benefit to the company and just helping us grow and be more efficient with our time and resources.
But I
Um,
think, one of the I don't, it's not my line of work, but
yeah,
deploying it for pro forma appraisals and running cash flows and running scenarios, with potential acquisitions, I think is also, I
yeah,
see a lot of potential there, and that's
absolutely.
probably how you're using it.
Um, would love to chat about interest rates. We still find ourselves in some of higher interest rate environment. And just would love to get your take and your perspective on just, I guess, more as it relates to how cap rates are adjusting across, the various asset classes. And if there's any out of that, are there any surprises that you've seen? And any things that any of the data that shocked you on maybe particular asset classes that have been more resilient than others or than what you thought they would have been?
Yeah, I mean, I think all of the above. There's a lot to unpack there. I'm fond of saying, with let's take the key variable for our industry, which is the 10-year Treasury.
Hmm.
I'll come on to the Fed funds rate in a moment or two, but between 2009 and 2019, the 10-year Treasury averaged 1.9%. It's now up at 4.3%. So, that rise in the 10-year Treasury, I think it caught us all by surprise. And, the question, a lot of people are talking, this is a sea change. It's going to be 4.3% forever. And I do think there are some, factors that are in the marketplace now, keeping interest rates elevated, namely that the stickiness with core inflation. I mean, we got a good result today. Inflation's gone down to 2.3%, a bit further. But I think core inflation is still quite high. And then we've got tariffs going to come through and keep it high. So people are a bit worried about inflation. And then you've got the yawning US fiscal deficit. So the US, and I don't know that, there'll be a lot of good things in Mr. Trump's big, beautiful bill, but I don't know that it's going to put the fiscal deficit to rights.
Hmm.
So, the more the debt to GDP ratio in the economy goes up, the higher the 10-year Treasury. So I think that 10-year is going to remain elevated for a while yet, but I don't see it necessarily sticking at 4.3. I see it trending down closer to 3%. Now, when that happens, is that 2 years or 3 years? I don't know. But the reason is, it's a simple reason. It's a reason that gave us that 30-year decline in interest rates from sort of 1980 through to 2019. That's 40 years, isn't it? Which is global demographics. People are getting older and they save more. So you've got more investment capital in the world and not enough investment opportunity. And therefore, that tends to depress interest rates. And that hasn't gone away. It's been highly disrupted by COVID, highly disrupted by, the inflation that came out of COVID, but it hasn't gone away. So I do see some ability for those long-term interest rates to come down over the next 5 years or so. So that should take some of the upward pressure on real estate cap rates away. Cap rates have been quite resilient. They've moved out maybe 200 basis points, but it could easily have moved further.
Are there any particular sectors that you've been surprised at that have been overly resilient, that they might have moved as aggressively as what you thought they might have, given the Fed fund rate?
Well, I think the whole of real estate, I mean, we've had an end of cycle event. I mean, we haven't had an end of cycle event in the economy, but certainly we've had an end of cycle event in real estate. And what do I mean? We've had a build up of new supply in multifamily, build up of supply in industrial, and actually, an end of quite a lot of new supply. People don't talk about it in the office sector.
Mm-hmm.
So we've had new supply dumped on the market. We've had values dropping because interest rates are high. But actually, I think the fundamentals of real estate has been quite resilient. So I think the most resilient sector has been multifamily. Q4. I think I'm right in quoting Q4 net absorption in multifamily was, I think, the highest in 40 years. Q1 net absorption in multifamily is the first time since 2001 that net absorption has been positive in every market in the United States. So although we've had an end of cycle event in some senses in real estate, because the economy has kept growing, real estate fundamentals have stayed reasonably resilient, albeit vacancy rates have trended up. in all of the sectors.
So using multifamily as the example, would you come to the conclusion that given that there's still significant demand, from renters needing housing, um, while there might be some distress on the debt side of things in the multifamily space, we also know that has been a lack of starts now over the last couple of years, since the rates have gone up. And so now we find ourselves in another, in a lot of markets where there's an actual shortage of inventory again, to where while these assets might find themselves in a distressed debt state, they're not necessarily distressed per se, and that prices will probably still remain high. You won't see a lot of cap rate expansion on the sales of those distressed assets. Is that a safe bet to make?
Well, I mean, multifamily, I think, more than any of the other sectors, depends on unemployment staying low.
Mhm.
It depends on the job market. So, and we're seeing, some worrying signs in the job market, but also some strong signs. I mean, job growth, over 150,000 for the last couple of months. So as long as job growth continues, I think multifamily absorption will remain pretty resilient. And with 3 to 5 million units of housing short in the United States, the single family just hasn't supplied enough, new stock, and particularly it's been quite good at supplying big homes. It hasn't been supplying small starter homes. So that and the fact that mortgage rates are 6.5%, I think and a stronger job market means continued resilience. If the tariffs and if the economic uncertainty, leads to a slower economy than we're expecting, and I'm not expecting, anything other than a mild slowdown, but if it does happen, then that would feed through into multifamily absorption.
Yeah.
And there are still some markets with quite high levels of supply, so that could push vacancy rates out quite quickly.
What are a few of the markets, any that come to mind that have I know Austin was one that had a excessive amount of multifamily inventory. Are there a few others that come to mind that you're
Yeah,
aware of?
Dallas and Phoenix.
Okay. Yeah.
And they're the markets that need the inventory,
Hmm.
because that's where the population is going, and the economic tailwinds in Dallas are hugely powerful. But you know what, real estate inventory is like. It doesn't come along in nice even supply. Sort of, there's a big supply pipeline in Dallas and Austin and Phoenix, I would say, are markets with high supply that could get a problem out of it.
Yeah. Let's talk about office.
Mm.
Again, I think we're all well aware, and we just have a general understanding that even prior to COVID, the certain more specifically B and C class offices, just we're facing challenges like functional obsolescence and occupancy rates trending downward. COVID, the work from home initiatives, really almost put a couple nails in the coffin there. But I guess just what is the data saying to you today, as it relates to office across the board? I mean, are there segments of office that are finding themselves to be resilient, like the new higher end Class A trophy assets, or are there challenges broad spectrum, across the board in that sector?
So yeah, I mean, it's been a challenging time. We've had a mild supply surge in office and a big demand shock, with work to home and COVID and the like. So nationally, vacancy has gone from 12 to, nearly 20%.
Hmm.
And companies have taken advantage of remote working to reduce their platform size. Couple of, when I asked my team last year, about the business we're doing, the answer came back last year that we were doing the same amount. This is 2024, the same amount of leases as in 2019, but companies were requiring 70% of the space. I asked the same question this year, and we're doing about the same level of leasing as 2019. But now companies are requiring, I think about 85% of the space. So companies have downsized. Leasing has got back to pretty well long-term averages. So companies are not, they've learned a bit more how to handle hybrid work, and they know what they're, getting better at forecasting what their space needs will be. And of course, everybody is going for the best quality space. So that flight to quality is around. So the vacancy rate, I think, in grade A, I can't exactly remember, but I think it's not much higher than 14%. And it might even be closer to 12%. And I'm telling clients really that if you want to get the best space, the amount of new stock that hit the market last year was about 35 million. It's going to be about 15 million this year, and it's going to be de minimis next year. So
Yeah.
if you want to get the good quality space, you've got to move now,
Do it
really.
now. Yeah.
My experience, but I've seen this flight to quality in 3 or 4 of the last four cycles, and the new cycle in offices always starts with a flight to quality because the space is cheaper, and why not get the best quality space when it's most affordable,
Sure.
and it tends to then spill out, from grade A to A minus to B plus to B minus. And I think that's what will take place over the course of this office cycle. And, the first round strategy, I think, when you're starting a new office cycle, is to buy that B minus space and refurbish it to core. And people, I think, who get involved in that. Now, that's quite risky. And I'm not sure the construction loans would be available to do it anyway. But I think it would be a very profitable strategy, for those that can execute.
So would you say that the data suggests that, at least speaking to the B and C class assets, that we might be at a bottom point? I mean, you had mentioned that the same amount of leases are happening today than what were happening, or 19, I think you referenced prior to COVID, correct? On an annual basis. So would that suggest that we might have hit a point of equilibrium, like we've kind of found the bottom?
I think so. I think that's right. I think we have hit the bottom, and then we're coming out the other side.
Okay.
And we did this work about 18 months ago, but we looked at vacancy. And you talk about B and C assets. B and C assets are maybe 70% of the market. So, but don't get the idea that 70% of the office market is not functional, because we found that 80% of the vacancy is in 10% of the stock.
Hmm.
So that it's concentrated. It's not, now all assets will have elevated levels of vacancy, but there is a specific problem with maybe 10 or 15% of the stock, which is leaking tenants and not coming back. But I wouldn't generalize that quite as widely as you imply with your comments.
Do you guys also track transactional data as well? And I ask that based on just what type of activity have you seen, if you're tracking it as it relates to office transactions, or more specific, even big institutional groups, pulling out funds or rolling out funds to acquire well located office assets. Are you seeing anything along those lines?
Well, I mean, I would say, investors in general are still a bit on the sidelines. It's a good opportunity for equity capital.
Hmm.
And I don't know that debt capital is particularly accretive to returns at the moment. So, but I think, you know, we were just getting going with investment last year, and then you had, the Treasury went up to 5%, and so that put investors on the sidelines. And we were just getting off to a good level of transactions this year, and Liberation Day came along. And I'm not making a political point there, but there's a degree of uncertainty around those policies. So I think investors are back on the sidelines, really. Investors tell us that they're targeting multifamily and industrial still. I think the best returns are in office and retail.
Hmm.
But as I say, it takes somebody who really knows what they're doing. And I haven't seen an overwhelming amount of office transactions yet. Lots of people are talking about it. Everybody knows the opportunity, but
Sure.
it ain't quite happening yet, I don't
Yeah.
think.
Yeah, and it's my understanding that even speaking to office to residential conversions, there's only a small percentage of existing office properties that actually have the right floor plate, the right structural design that would make them, a good candidate for an office residential conversion. So I don't. I think years ago, just the general chatter was that's ultimately what's going to happen. Located assets are going to be converted to something else. And I just don't think it's going to play out on a grand scale like most have thought it might have, a couple years back.
No, I
So
mean it's really, it's exponentially growing at the moment.
yeah.
But even really wildly extrapolating current trends, it's going to be less than 1% of the stock per annum.
Hmm.
And if you have got 15%, let's say, of the office stock, which is technically, functionally, locationally obsolescent, it's going to be 15 years. It's going to be 2 cycles before
Yeah.
all of that space is absorbed. So that's not going to happen quickly. There are opportunities, and some of that concrete and glass type stock from the 80s and the 90s. I don't know that's capable of being converted.
So you've been through a number of cycles now. I mean, what are some similarities that are apparent to you, that are happening at this present time that might be reminiscent of another cycle period that you've been through in the last 40 years that you've been an economist?
I mean, the things, as I say, uh, I've seen it worse. This is probably the mildest cyclical end of cycle that I've seen in
Hmm.
40 years. But we've got, the typical things. We've got a decrease in occupier demand. It's been relatively resilient in in industrial and retail. But it is down on what it was, 2 or 3 years back. We've had values falling 25%. We've had not a huge amount of distress, but quite a lot of stress in the capital, the capital stack that finances real
Mhm.
estate. So I'd say this was the mildest downturn, and the fall in values, the rise in vacancy, and the flight to quality are all
Mhm.
things that I have seen before.
Okay.
Um, and I did
So,
see, there was something similar to this, in the early 90s, in the UK, we had a very, very severe service sector recession. And, office vacancy, rocketed and went high. So I've seen the office market before really badly hit by a demand shock. And that's what we've got in offices right now. There are a lot of similarities
yeah.
across cycles.
So crystal ball time, Richard. 3 year outlook. If you had to look 3 years out into the future, I mean, what would you see as the most change aspect of the commercial real estate landscape? And that's, I guess either for better or for worse.
Um, Most changed landscape. Well, I mean, um, do I think that the digital economy is continuing to remake usage patterns. I mean, I wanted to say there that I think there's a lot of continuity in real estate. There's
Mhm.
much more continuity in real estate than you get in other asset classes. And my old company that I mentioned, Grosvenor, it's a 300-year-old company, and some of the real estate assets, as I say, that they've lasted for 200 years, and there's a lot of continuity. They're the same assets. They were built
Yeah.
as housing, became offices, and became housing again in central London. So there's kind of a lot of continuity. But I do think that the digital economy is reshaping usage patterns, and it's changing the way. Obviously, we've seen it for 10 years now in retail and industrial. And I think that kind of underpins continued secular growth in industrial usage. We're seeing, and retail, will be a little bit circumscribed. Um, and just the way people work as well is obviously, transformed into a much more kind of hybrid, fluid, kind of workplace situation. And I don't know that that's going to go back. The office sector is going to be vibrant. It's just going to be 15 or 20% smaller than it used to be. And all of that points really to fundamentally strong demand for multifamily and residential type properties and kind of mixed use and amenities around kind of those residential clusters. You've got the live, work, play neighborhoods in downtown areas. You've got the urban, suburban type neighborhoods. And you've even got kind of worky, leisurey type of places in resort areas as well. That's how I see the change taking place.
As we work to wrap this up, Richard, just curious. Obviously you get to feed through a lot of different data points on a regular basis. What keeps you up at night when thinking about the global commercial real estate market? And I guess the second question, a follow-up question to that would be: are there any hidden risks that maybe us as investors aren't paying enough attention to at the present time?
Yeah, what keeps me awake? I think we're on this long extended cycle. So there was some interruption to growth from COVID, but broadly speaking, once the stimulus had gone in, the COVID recovery was pretty rapid. I think I have a sense that we're overdue a recession. And when I look at the normal triggers of recession, sort of high and rising interest rates, rising inflation, over leverage in the consumer sector, over leverage in business, it's not there. But nevertheless, I have a disturbing, worry that, the average business cycle in the States is about 9 years. And, we did have a sort of recession with COVID, but I think we got away quite lightly. So that keeps me awake at night. And what would happen then, I think, would be why it keeps me awake is because if we got a recession and unemployment rate went up, then I think that would hit the multifamily sector. And I think the banking sector has been able to extend and pretend because the real problems in real estate were confined to one subsector, which is offices. If the problems in real estate went, broader into multifamily, I figure that would go into the banking sector, and then we'd have some sort of credit crisis. So I think that's my worst case scenario. I don't see anything other. I don't see that shaping up to happen. We could easily. I see more probability that we'll do well, and there's upside scenario too. But that's what bothers me.
Okay. No, I
That we
appreciate
haven't had
that.
a recession. So if you're buying now, what the implications are. I mean, I think it's a good time to buy. I think there are generational opportunities. But if investors are doing that, they just need to make certain that they can weather a near-term or a medium-term recession. And real estate can do that. You can do that, but you've got to don't assume the current conditions of solid fundamentals are going to be there for a whole 5 to 7 year hold period. You've got to look at your downside scenarios. Can you weather it? If yes, then you'll probably come out the other side and do very well out of it. But you just need to factor in a recession event, I think, for your investment purposes.
Yeah, no, fantastic. Well, Richard, this has been a lot of fun. I really appreciate you coming to the show, sharing your insights, and I guess for those, I know that you're making a pivotal career change here in the very near future. But is there for those that want to maybe connect with you? Are you active on LinkedIn, or is there another place where they might be able to track you down, a website, in the event they want
I'm
to learn a
active
little bit more?
on LinkedIn, so message me on LinkedIn, absolutely. And for a couple of months, I'm richard.barkham at CBRE.com. But yeah, I respond to everything, and I'd love to hear from folks who've got interesting questions to ask.
Fantastic. Well, Richard, thanks for joining us here today.
My pleasure, absolute pleasure.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. Take care now.